Thank you for joining us. So we will be talking about insurance around digital asset businesses, how it compares to the old ways of insurance, traditional businesses, and what we look out for now with this new world of Web3, crypto, and blockchain businesses. My name is Dan Ross. I'm what's called the Digital Assets Underwriting Manager at Superscript. Superscript's a Lloyd's of London insurance broker, and we have the largest digital assets broking team in the world. What we do is work with specialist insurers in London, in Lloyd's of London and globally to help place insurance solutions, often bespoke insurance solutions for crypto, blockchain, and digital assets businesses across the whole ecosystem, and in just about every country. Some of the learning objectives today is we are going to be understanding the principles of commercial insurance. So we've got a bit of the language and the context of what we're doing when we're talking about commercial insurance and risk. We'll be understanding the various products available out there and how they've developed over the years. And you'll see that actually what we're doing is taking very, very traditional insurance knowledge and just applying it for the slightly tweaked and new parameters of Web3 and crypto. We'll be understanding what dictates the price and availability of digital assets. So really talking about the insurance market itself and what it might be like for you to interact with it. And then a little bit about how you can work with the insurance industry to access fit for purpose and bespoke coverage for your digital assets business. Right. What we'll be discussing is a brief intro to commercial insurance, just a bit about the history of insurance. It's actually one of the most interesting parts of insurance generally, so it would be a shame to miss out on it. We'll be talking about what insurance is actually useful and where it's not useful. We'll be going through what the parameters of insurance are, so what makes an insurance policy, what defines it, what the limits of it are, and some of the nomenclature around how to discuss insurance with partners, both in insurance and in the rest of your commercial business. We'll be talking about the types of insurance. As I said, we'll be going through the actual insurance products out there and how they're tweaked and made appropriate for digital asset businesses. We'll be talking about what affects the terms of your policy. So this is a bit more into what you might expect when you go to look at insurance, what might be available in terms of what's out there in the market and what the market's actually doing. And you'll see it's actually getting insurance is a combination of many different parts coming together, some within our control, some outside of our control. But all of these things have to be put together to really achieve the insurance policy and risk management practices you're hoping to be purchasing and getting value for money for when you buy them. And then at the end, we'll just be taking any questions, any additional questions that we haven't answered throughout the talk. Happy to answer any questions during the talk. It's always great to ask questions at the time and answer them to give a bit more context and flavor to what we're looking at. And there's always some great niche questions from all sorts of walks and careers. So yeah, we welcome them. So, real brief introduction to the history of insurance. As I said, the history of it's extremely interesting, and it's very important to understand it too when you're working in the insurance industry to see where we've come from and where we're going to, but also because it gives you a fairly good inspiration and indication for what it might look like in the future. So when we're talking about new types of insurance coming around, particularly digital assets, but also things like AI, it's really about the history of insurance and where our knowledge has got up to today, to make sure that we're creating insurance policies in the future that are fit for purpose and what the world needs to grow. Insurance is one of the oldest financial instruments, which will be no surprise, but it might surprise some people that it actually predates the use of coins as currency. I believe coins came about in 600 BC in what is now Turkey. But there's evidence of insurance thousands of years before this. It might be a slight surprise, but it eventually won't be a surprise that insurance all started with maritime shipping. And that will be a really common theme throughout insurance and its history. It always seems to be the shipping of goods and their expensive value across trade routes is always the thing that's concerned investors and merchants the most. And that's really where the need for insurance came about, because these voyages would sometimes not make it to their own destination, and there needed to be some financial instrument to make sure that businesses weren't collapsing and dying or becoming bankrupt the second one ship got lost. Um, Early insurance. I picked up this picture on the right. It's called the Cove of Hammurabi. It's actually a big, big, big stone structure. And what you can't see on there is a bunch of tiny inscriptions talking about all sorts of different things about Babylon at the time, and also includes things about finance and insurance. The way they talk about insurance on there is that when merchants were giving loans to these transporters of goods, whether it be the ship or the people hiring the ship, and should the voyage with all of the contents of the ship eventually make it to its end destination, the loan would be repaid back to the merchant with a little bit of interest. But the cool thing and the insurance part of it is if the boat never made it, i.e., it's sunk or perhaps may have been pirated, the loan wouldn't have to be repaid back. And of course, there is an upside and a downside there for the person giving out that loan. And there becomes a really interesting dynamics of uh, going into business with other people to share risk management, to share risk and to manage risk in a way that works for everyone in kind of uh, almost a circular way. So it's not until this stone and what we saw about the merchants not having to pay for unsuccessful voyages is the oldest recording essentially we have of commercial insurance. Modern insurance is still around and still around and not that too different from its original forms. The earliest kind of traditional Western insurance policy or evidence we have is in Genoa in Italy in 1347. And a little later on, developed the story of Lloyd's of London. Lloyd's of London, to anyone that doesn't know, is kind of the heart of complex global insurance. It's a centralized market full of hundreds of insurance companies that work within the same building and are accessible to Lloyd's of London brokers who can go around and place little bits of complex insurance around many, many underwriters to share out the risk between them and eventually come out with a complex insurance policy that allows people to go ahead with their commercial endeavors, try and achieve the best, but there is a safety net there should things go wrong. And that safety net is absolutely essential to global business at any level, being able to succeed into future years and eventually become that big sustainable company that everyone looks to try and become. Insurance in Lloyd's of London started out in a cafe. It's a bit of a ramble, but it's a really interesting part. It was Lloyd's. Lloyd, in fact, was one man, and he owned a cafe, Lloyd's Cafe. And you would get these merchants that would sit in there having their coffee, and much like in the Code of Hammurabi, people who were going on commercial voyages and doing transport and maritime shipping would come to this cafe, talk to the merchants, and essentially come up with an agreement there and then on a piece of paper to form some sort of insurance should the voyage not eventually get to its end destination. That hasn't changed in I think it's 336 years since it opened, where now Lloyd's of London is just a much, much larger version of a cafe where there are still underwriters sat at a desk with people coming towards those underwriters to propose an insurance agreement for all kinds of things now, not just shipping, but the practice of sitting there with someone who wants to protect someone, something, an endeavor, and the person underwriting that endeavor hasn't really changed in several hundred years. It's very much the same. There's paintings all over Lloyd's of London of this, and the only thing you can see that's actually changed from the painting to real life is there are now computers on the desks instead of just big quills and pieces of paper. So that was a little bit about the history of insurance. There is so much more to it. I recommend you look it up if it's of any interest to you. So what's insurance for? Insurance primarily is for what we call risk transfer. Now, there are risks that that might happen to your business that are unforeseen. And for all the protection and risk management that you've done as a business, it still might not be enough, or a business might need support to overcome whatever event or hurdle is happening. Some modern examples of this are a cyber attack happening. You might not be a cybersecurity company, so you might not know what to do to react to it. The theft of your digital assets, you might not be any part of law enforcement or prosecution yourself. So if they go missing, it's kind of outside of your control. And regulatory fines, a common theme we're going to be talking about. We all know, being in digital assets, the regulatory landscape is kind of all over the place and very unpredictable. So that's, again, unpredictable risks that you can plan your best for, but in the end of the day, there might be elements to it that you really can't plan around. And that's really where insurance steps in. So last line of defense for your business, should you have tried everything and that not quite be enough. And this transfer of risk is absolutely essential, as I said, to the long-term growth and viability of a business. If it only takes one complaint, one lawsuit, one new law, one accidental loss of assets or something like that to bring down your business, you would be bankrupt that then and there, and there would be no continuation of business. And we know that doesn't happen for big and well-established businesses. And that's because they've done excellent risk management and risk transference, where they've identified things that really could end their business and have worked with underwriters to transfer that almost uncalculable risk of things that are just so much outside of your control. There's nothing you can do about it. It's very important to tell you, though, that risk transference does not mean insurance policies cover balance sheet risks, i.e. pure financial top line and bottom line risks, or typical business risks. So choices you've made in your business and forming it not working out for you. Insurance policies aren't meant to be an asset for a business. It is meant to be there as an agreement in case something should go wrong outside of your control. That is to say, policies aren't there to make up for where a business isn't performing as much as it hoped it would have been. That said, though, that risk transference and being able to say, okay, these circumstances are covered for and will not be taken out of our pocket, allows businesses to come to that financial stability. Protection against losses, against any single one event, is what we're trying to get to throughout the year. And when you're looking at an insurance policy, the idea is, okay, is this enough to cover the potential events we're worried about? The potential events we're worried about should the worst happen over the 12 months. And that only comes from understanding the risk of your business very well. For regulatory compliance, more and more, although the regulatory landscape is all over the place, we are quickly seeing insurance established as part of regulatory rules. We're seeing this particularly for people like custodians, exchanges, and those in traditional financial institutions. We're also seeing it those where kind of crypto crosses over into other more traditional financial practices. But this regulatory compliance is a big deal worldwide. We're seeing much more affirmative regulatory coverage for Europe, the Middle East, Australia, and New Zealand. And we're seeing great products out there to cover the regulatory uncertainty for the US, but then again, state by state and between changes in government and all sorts of things, it's actually very hard and a lot riskier to be able to understand what the regulatory landscape and what regulatory compliance looks like in the US, which is why we would suggest insurance for this particularly is something that digital asset businesses that kind of straddle this middle ground of being a little bit of both, but being quite uncertain in legal and regulatory eyes, that this kind of transference of risk is essential for many of the businesses that we see. And insurance really is an access to expertise. Yes, you are trying to get over risk transference over in a new financial instrument that is going to keep your business going on in future. But what the real value also comes from the people that are essentially working for you as a broker or as an underwriter to make sure that your business has everything they need should everything go wrong. And the people you're working with in insurance have been doing this time and time again. We're very familiar with placing insurance as much as we are familiar with helping with claims and helping with immediate situations where the right people need to step in at the right time to make sure that your business minimizes its risk and kind of remediates situations as fast as possible. That is helped on and spurred on greatly by the insurance relationships you have with your broker and underwriter, but also the third party services that they can tap into to come and help your business, on top of the money they might just be able to give you to help remediate a situation. So insurance is really about you understanding the core risks of your business, understanding what is transferable outside and what is kind of just a business risk, working with the insurance industry to come to a solution that affirmatively covers all of those risks and concerns that you have, and then working with those people to understand back and forth what other risks there might be, how people might be able to help you, or where you might not need to be so uh, paranoid or even worried that something might happen. We've got a lot of expertise as to many, many different situations with many, many nuances across many, many types of businesses. And that all comes together over the years with combined teams to really provide a service and expertise to you that is what you want without you quite knowing that you needed it. And if we can do that, we're absolutely delivering on what insurance should be. Right, some parameters of insurance. So, many of you have dealt with insurance in one way or another before, whether it be car insurance, house insurance, health insurance, maybe mobile device insurance. All the terms pretty much are very much similar between your consumer insurance that you might get versus large commercial insurance. So we have policy limits. This is the amount the policy will, on aggregate, cover you for, or within certain situations will cover you for. This is the big top line amount that a business might be able to claim over a 12-month period. Typically, in commercial insurance, this is done in the millions. In the millions of limit, not in the millions of premiums or what you would pay, but the overall amount that you can claim from the policy, typically done in millions. Deductibles, retention, and excesses are the out-of-pocket expenses the business needs to pay out ahead of time before being able to claim on their policy. There's a few reasons for this. One, so businesses have some skin in the game, and they're not just using a policy there, not just claim on a policy every time they feel like they're entitled to some money because they paid for a policy. It's not like that. There has to be a kind of equitable relationship between what someone can claim on and what will be paid out for. And deductibles, retentions, and excesses really help align priorities between the underwriter and the business itself to make sure that insurance policies are being kind of claimed on fairly. Exclusions and limitations are a very clear set of circumstance put in your insurance contracts to say what isn't covered and what circumstances they're not covered under. This is where you insurance expertise and insurance brokers working for you really pays dividends, because in the end of the day, an insurance policy is just a promissory note in a contract, and that contract and the terms in it are final. Once a claim has been established, it's really a case of legally looking at the insurance contract given the circumstances to see the viability of the claim and whether the insurance policy was intending to cover that circumstance. Working with insurance experts are the people that are going to make sure the nuances of your businesses are covered in the specific claims and circumstances of your policy wording. This is where you're spending the money, essentially. It's not even the policy limits you're paying out for or paying a little bit over and above market averages for insurance. This is where the additional expertise and foresight in what your businesses might be experiencing in the future really comes into play, and is really you pay for what you get in those circumstances. So the understanding the exclusion and limitations of your insurance policy, not just what you're covered for, is absolutely essential. Premiums are what you pay for the insurance policy. They'll be paid to your broker, and your broker will deal with all sorts of management of those premiums, be it do they pay it to underwriters or maybe pay insurance related taxes and other compliance issues that we need to get around when we're supplying your insurance. Much like exclusion limitations, policy terms and conditions are sections in your insurance policy that dictate how it will act in certain events, and general terms and conditions around how insurance policy law acts and how obligations are kind of given or assigned to both the insurer, the broker, and the insured company to make sure that everyone is acting together and in everyone's best intentions should a claim in the future come to pass. And one you might not have come across before explicitly, but you may have seen it kind of implicitly in other places, is third party versus first party risk. So there are first party risks, i.e. something goes down in your business or breaks or goes wrong directly within your business, and those kind of things under your control, versus things that are outside of the control of your business, or you think third parties outside of your business that you may affect in the course of you not doing your job properly. So insurance coverages and insurance terms also include kind of terminology to affirmatively cover things that are going wrong with your business, things that are going wrong with third-party businesses that affect you, and things that are going wrong with your business that affects third parties. And all of these parameters put together form a fully formed insurance contract, which you can rely on, that you can make sure that it's covering the circumstances that you're worried about, and make sure it's compliant to law and should act how it should do should a claim come to pass, so that everyone is on the same page, working together to make sure that in the end of the day, the situation you are in is remediated and you are doing business into year 2, 3, 4, and hopefully into year 50. And who knows, in crypto, it might be the year 500. We'll see. We're going to run through some types of commercial insurance. To anyone that's tried to get insurance for your business before, you will recognize many of these. To those that haven't, they're actually fairly straightforward. Like I said at the beginning, insurance has been around for thousands of years, and the way we insure things and what we're insuring hasn't changed too much. It only really changes with new businesses, new industries, and kind of how they behave. We're going to be going through directors and officers insurance, one of the most common ones that we'll see for crypto CFOs, professional indemnity or technologies, errors and omissions insurance, cyber insurance, custody insurance and crime. And then we'll be having a really brief mention of what smart contract insurance currently looks like, what staking insurance currently looks like. And although we won't be going into it, another very, very large part of insurance is mining operations, computing, and data centers. So Bitcoin mining operations are essentially big data centers, just with a different type of computer inside. And you'd be surprised at the amount of insurance that goes into property to protect computing and mining that goes towards processing cryptocurrency transactions or securing the network in some sort. So directors and officers insurance, this is, as it says on the tin, intended to protect the directors and officers, the high-level management of a business, from personal liability in the course of them conducting that business. So that is to say, if they are directors and officers and somebody comes along to sue the company and they specifically name the directors or the officers of that business as well as the company in the lawsuit, then this policy is designed to protect the personal assets of those directors and officers. This is super important because if you don't have this, a legal suit has cause to come directly take damages from individuals, and individuals aren't expected to tolerate commercial lawsuits that would essentially bankrupt them very, very quickly, almost always. If that were the case, and this insurance wouldn't be available, it'd be very easy for businesses and people to come along and try and destroy other businesses and other business people simply by directly attacking them and hoping that they can win a war of attrition by making them bankrupt before they can fight back. So this is a very old type of insurance because there's always been disputes, there have always been people unhappy, and as the law and regulation has grown across industries, but of course within crypto and digital assets, litigious natures of business, of running business, is something that has to be protected by. It's so widely bought that it's often one of the first insurances bought by companies. It's often mandated by investors. And for larger businesses, it's almost always a absolute necessity from a regulatory standpoint. The more decentralized the technology being used, the more the unique challenges of decentralized technology comes into litigation around directors and officers. So it can be very hard for the kind of stateless entities or completely on-chain DAO formations, where it's not known who is in charge and therefore who should be responsible should the actions of that business put other people out. It's been hard and sometimes ambiguous to know who the lawsuit should be put against. So buying directors and officers insurance for these new kind of ways of running business might not seem applicable, but it's absolutely essential to protect the uncertainty of what comes with running a DAO or a stateless entity. And we saw, I want to say recently, but it's quite a while ago now, Oki DAO, who were found to be potentially running an illegitimate cryptocurrency exchange, who had no real strong particular leader or founders, and ran under a decentralized DAO structure, found that all participants were served a notice for the lawsuit being acted against them by the regulator. That was found okay to do because the regulator couldn't interpret or decide who would be the person in charge of this DAO and therefore the person that should be prosecuted. So that ambiguity has led to what we fear the most, which is people who absolutely should have no liability for what happened in that DAO being taken to court potentially for or under the cosh of the regulator for things they really had no control over, but were blamed because of the lack of clarity around who runs that DAO and who doesn't. Types of claims that can come in is, for example, breach of fiduciary duty. So this is where the people running the business aren't necessarily acting in the best interest of the business, and people outside see this and want damages because of it. Misrepresentation of what the business can do or what the investment into the business was. Securities litigation, which is going to be a big topic for many crypto CFOs. Is the token that they're working with or custodying or helping transact a security or not? And will they be wrapped into a securities violation or investigation themselves? Or would their business model fundamentally be broken by new securities law coming about? Regulatory actions, again, very much if a regulator has found that you have acted against what is legal, and you do have a directors and officers insurance policy, this will often cover regulatory prosecutions against you, simply because the underwriters truly believe that for to the best of their knowledge and to the best of the efforts that you've made as a business, we don't believe you'd be taken up under a securities case, but in case that does come along, directors and officers policy is there to help out. Similar with bankruptcies, there is many litigation around bankruptcies and many proceedings that require funding. And then employment practices and HR issues, simply the act of building a team and employing people. It might be that you did not act the way that you should have, even unintentionally, and therefore directors and officers insurance will protect you and the individuals running the business against any lawsuits that come about from those very typical employment issues and employment law violations that can happen at many, many businesses. Professional indemnity or technologies, errors, and omissions. So very straightforward. This is, do you have a contract, whether it be affirmative and completely formed or maybe a little more passive in terms of conditions, with your users or your customers or your clients or partners, or however you want to look at them? If that contract is there and you have broken it, and a third party or the other side of that contract comes to claim damages because of you breaking that contract, that is exactly what professional indemnity or technologies, errors, and omissions contracts are for. Professional indemnity is and techie, is kind of used interchangeably. But historically, professional indemnity was around very more traditional contracts, whereas technology, errors, and omissions came about because of software as a service and the internet becoming prevalent in business models. And therefore, we kind of needed to say the breach of contract and you providing the technology led to a claim happening. So it's very much the same thing. And now we're talking about digital asset businesses. This idea of a contract being formed and a contract being broken is really the only principle you kind of need to understand in this and what it applies to your business. Now, it's important to say that breaking of a contract doesn't explicitly mean a smart contract in any way. It is a traditional legal contract between two parties to engage in some business. There is other smart contract cover that we'll be referring to a bit later. This professional indemnity insurance is so fundamental to businesses interacting with each other well and into the future, is often mandated in the contracts that you all sign. So on top of all the terms and conditions of your contract, often professional indemnity a certain level of professional indemnity cover is mandated to make sure that should you accidentally do something wrong, that third party is comfortable that you have the resources and the insurance to pay out or address the legal issue that they brought to you. This can be done by a ton of ways, breaking contracts, and whether it be through negligence or accidentally doing something, misrepresentation, once again, of what your software or services does or doesn't do, or more technology related events like software system failure and data loss. Cyber, which is a much newer insurance type. It really came to fruition around 99 during the dot-com bubble, and has now grown over the last 25 years into something very kind of not well understood, but very actively developed insurances. This is everything to do with computers and computers going wrong. Data breaches and losses, ransomware, phishing and social engineering, loss of digital assets, system downtime, business interruptions, all the things that happen when your systems or systems you rely on go down. And much like we were talking about the third versus first party coverage earlier, this is one of those insurance policies that actually covers a combination of both. So there might be expenses or downtime or things happening, losses to your businesses should systems you rely on go down, like I said. But again, if you provide systems or software to other people and your systems go down, then that is third-party coverage as well. So there is a little bit of what happens to who should a computer system go down, be breached, or be broken in some way. And that's essentially what we're trying to get at with cyber, which means that of all the applications that you'll fill out and all the questions you might be asked of insurance, cyber is going to have the most questions in terms of volume, and it's going to have the most precise questions in terms of, do you have XYZ control in place, software in place, or practice, or what have you, to make sure that you've already completed as much risk management practices as possible before an insurance policy is given to you. So one piece of advice here is, if you do be going through cyber application forms in future, there are a very good checklist of what the best practices are for the industry. One thing I will say is many digital asset businesses fail quite badly to have good traditional cyber controls, because they believe their on-chain nature means that the only real point of attacks is private keys and wallets that they have, which is just not the case. There are many traditional cyber vectors that have led to the biggest breaches and hacks and claims in digital asset businesses. And this is where we see some of the difficulty really happening, where very highly technical businesses have kind of overlooked very traditional practices that still need to be put in place and are absolutely essential to be not only safe into the future, but to be able to obtain cyber insurance, which again is slowly becoming a new regulatory requirement and a requirement of contracts into the future. It's important to note that cyber isn't covering explicitly, well, it is explicitly covering generally computer systems, computer networks of some sorts, and the interaction between them. it is often excluding smart contracts itself, and perhaps some of the on-chain infrastructure that doesn't relate to proprietary technology. So some of the open source technologies businesses might adopt to their technology stack, and things going wrong with that. Again, there is affirmative cover for kind of smart contracts and more on-chain risks that are available to the rest of the market, and which we'll be briefly mentioning in the next slide. So these are three of many new coverages that have come around and have been adapted from old insurance to really address new risks with digital asset businesses. So the biggest one in terms of volume of insurance is without a doubt custody and crime of digital assets. Not only have big financial institutions and exchanges obviously holding a hell of a lot of crypto and digital assets been worried about that. It's now a case where regulatory requirements are coming in for custodians of any digital assets for third parties, which are, I would say, actually quite overbearing in some circumstances, and on the bottom end, very robust in others, which is to say that insurance for custodians has been in very high demand, has pretty significant supply. But now we're seeing banks and real traditional financial institutions come on. That supply is going to fall short of the requirement. And we've started seeing requests for literal billions in insurance limits for individual establishments, just because of the new laws coming in, where overnight they are now required to hold a significant amount of insurance or one-to-one reserves of digital assets that they hold on behalf of third parties. Like I said, it's extremely overbearing, and really the only way to address it in a equitable way, unless you have masses of reserves for yourself, is through insurance. Smart contracts, as I said in previous parts, particularly in professional indemnity and in cyber, smart contracts and smart contract related claims, whether it be a very small element of a smart contract, which should be considered a computer system, but in the eyes of typical insurance isn't. Smart contract insurance simply goes, we will either make an insurance policy that affirmatively covers what smart contracts do and how they're supposed to behave, or more commonly, on a professional indemnity, technologies, errors, and omission policy, or a cyber policy, we are having the smart contract exclusion, which excludes the insurer from paying out for any claims relating to smart contract technology itself, to remove that, not necessarily affirmatively covering it, but now it's not an affirmative exclusion, and therefore won't be excluded or kicked out should a claim relating to a smart contract come in. Now, understanding the robustness of what your smart contract coverage, whether it be affirmative or implied, looks like, is going to relate heavily to how core smart contracts are to your business and how complex they are. But that is to say, hardcore decentralized smart contract only businesses should be looking for smart contract insurance, and businesses that are working within digital assets and crypto that have some exposures to smart contracts in some form should look to work with their broker to simply remove exclusions. And therefore that means that you still have the coverage that you previously had, now with the additional coverage of smart contracts, without having multiple different policies trying to work out what is covered and what isn't covered. Sometimes it's much easier to just remove exclusions to provide coverage. And that's a very typical thing we do in insurance. And then staking insurance, which is one of the ones that have gone from 0 to 100 over the last 12 months, not surprisingly through the Ethereum merge, but also many other proof of stake chains coming online and being supported. This staking, again, can be an exclusion. So blockchain related losses, for example, might be excluded in an insurance policy, but staking coverage will affirmatively cover staking operators for penalties or loss of cryptocurrency should in the operation of a validator, you be penalized for one way or another, whether that be through your own fault, through downtime, through some network-wide interruption that's happening, through perhaps a bug that's systemic through many of the clients for staking providers. You can see why the broadness of professional indemnity, technologies and emissions contracts and cyber contracts don't quite cover the parameters of staking and how staking businesses are run and work. So that's where we couldn't get typical insurance and more traditional insurance policies and tweak them for staking. We've had to make staking products that are different to all the other products, essentially. And insurance will keep doing that where new on-chain or novel risks come to fruition, and we need to find a way to address them for you and businesses like you to, again, make sure that you're trading into the future and we're both there together without having single events essentially disrupting or destroying a business. So very quickly, I'm going to talk to you about kind of what kind of dictates the insurance policy you're going to get. This is in no particular order, but is showing you that there are many different aspects to be considered by both yourself, brokers, and insurers when purchasing insurance. So for some of these fundamental points are going to be the types of insurance required. So we just went through the types of insurance, and what you're going to find is each one of them have their own typical rates or prices in premiums of how much they will cost. They'll have their own nuances as to how much limit is readily available and how much limit underwriters are willing to give. And it's going to depend on many other small factors around, for example, exactly what the parameters of your professional services or technology is doing, and looking at that in the context of where you are in terms of geographics and jurisdictions and what local and global laws mean for your business model. Now, this is something that many businesses, crypto businesses, would have gone through themselves, trying to understand where they can take their technology and operate compliantly to try and grow markets in different jurisdictions. We have to do this day to day to make sure that the business you are operating and where you're operating in is affirmatively protected by the insurance policy that you had to make sure that it will react to the nuance of the particular jurisdiction or the particular service that your business is doing. And again, this is where insurance and insurance brokers comes in to make sure that every part of the policy that you bought, the terms and conditions, the exclusions and the affirmative coverages in them are exactly what you need, not just for your business and business type, but where you plan to trade in future and who you plan to trade with. And then finally, and it will be no surprise to you that insurance market conditions is one of the overarching reasons why there are fluctuations in the price of insurances through different products, through different regions, through different jurisdictions, and between different insurers. So insurance market conditions is actually quite a global thing. For example, the market for D&O insurance will fluctuate across many industries at similar times in similar ways, simply because of how much D&O insurance is available and how much is being demanded and by whom. There are many, many different insurance market nuances and conditions that will affect these things, but these are typical industry fluctuations that was going to affect any insurer and anyone buying insurance anyway, and is not necessarily something that's a part of being part of digital assets. That is to say, though, over the 6 years I've been doing digital assets insurance, the willingness and the market conditions for insurers willing to underwrite digital assets insurance has really flourished, particularly in the last 18 months, to where there are many, many more insurers willing to provide affirmative digital assets coverage, which is to say the market conditions are very much becoming in the favor of people buying digital assets insurance now. And where we went from 6 years ago to being lucky to get one insurer to provide one quote, we're now regularly able to provide competing quotes from many different insurers with many different types of insurance policies to each client that we deal with. And the final part of that is each insurer has its own credit rating, which will be maintained through its regulatory obligations towards reserving and capital supplies. To make sure that that insurance company will not only be trading on into the future themselves, so that they can honor insurance policies for new businesses, but to make sure that they have all the financial obligations in place to serve their outstanding obligations to the insurance policies they've already put out there. That is to say, credit ratings for insurers will be those at the top that are the most robust and largest will often warrant higher premiums. But that is to say, companies and insurers with lower credit ratings will have perhaps lower premiums, but that is in line with a small financial risk of you now taking a slightly less supported business. There is a lot of variance in being able to get the right insurance policy for you if your business and yourself is willing to perhaps not or willing to perhaps look at several different types of credit rating and what that might mean for your business. That's something that your insurance broker will be an expert in, again, as mentioned before. And finally, a few points on working with the insurance industry. So these are some tips, tricks, things you need to get in your head and things you need to go work on if you are looking to buy insurance for yourself, either soon or for your business later into maybe further down the path of your business. So number one, deciding factor of how this is going to play out for you is choosing the right insurance broker, without a doubt. Make sure your insurance broker is specialized enough in what you do to be able to talk about your business in your language. You want to be feeling like you are talking to an insurance partner that not only gets your business, but is going to go out and try and be as much of an expert in your business as you are. That's a really key indication as to whether they're going to understand all those little nuances and have the experience to address all the those insurance policy issues, risk management issues, issues with the wording, or making sure you've got the right insurance policy is really going to play out. If you don't have the right broker with the right expertise, they are going to completely miss out on all of that nuance. And when you get to claiming on your insurance policy, you'll get what you pay for, unfortunately, even if you didn't intend for it to be that way. And going with the wrong broker will be the make or break between that insurance policy paying out or not, should something crypto specific come along to your business in terms of adverse events. Looking to build long-term relationships with the brokers and insurers is highly, highly recommended. Whilst it might seem the most intuitive to get as many insurance brokers out there working for you to get as many competitive quotes as possible, it's actually the most efficient to go with brokers who understand your business and have many direct relationships with direct underwriters who will understand your business too. And instead of being a broker that doesn't really know what they're doing, but going to market to try and get insurance anyway at just purely the cheapest price possible for you, is not going to be going to the insurers that are going to understand your business and perhaps charging you a little bit more for bespoke, fit for purpose solutions that your business actually needs. So building long-term relationships with people that understand your business and have insuring partners that also understand your business is going to be far more preferable, not only in the first year, but far into the future for you attaining insurance, the right insurance you need year on year. Setting expectations is extremely important. You need support from your board or support from the founders or the people that will be signing off to really engage with insurance. This is where many people fall down the most. If you go out to understand insurance, but you take all that information back to your board and find out that actually the budget that was assigned to you was a quarter, 10% of what you thought it was, or what the market is expecting, the insurance market is expecting, there's got to be a discussion or some sort of action there to make sure that you are able to maybe transfer risk or address risk management issues in your business in a way that is attainable on the budget that you have. And understanding this between yourself and your broker is absolutely critical to being able to go out to market and get the right insurance for you. Setting expectations again on the pricing of insurance. It is much more expensive when it is more bespoke and fit for purpose. That's not to say there is a middle ground of actually very generic insurance policies being sufficiently able to cover digital asset businesses where maybe they are just using or interacting or adjacent to digital assets as opposed to using them as investments or tokens themselves. It might be that a generic insurance policy is good for you, and at the price, the very, very low generic price you would be getting is worthwhile, but it's going to be a broker that's going to tell you if that policy is worthwhile for you. Where it's not worthwhile and where you really, really would benefit from affirmative or bespoke coverage for your business, it is going to be more expensive, sometimes many times more expensive than you're expecting compared to traditional, very generic insurance policies. But again, you absolutely get what you pay for. And if you have gone through the process with the right broker and the right insurers to get the right policy, yes, it won't be cheap, but I guarantee it will be worthwhile. Um, uh, Digital asset insurance requires many, many answers to questions to application forms. As I said before, the one you'll fill out the most questions for is cyber insurance, but that's not to say all the other types of insurance don't have their own questions that are not only going to be quite general and perhaps a bit broad, but you can also expect underwriters who are really trying to understand your business to ask additional questions on top of it that relate specifically to your previous answers or your business that they would like to understand a bit more. This entire process takes a lot of time and often the entire process for you to collect information can take a lot of time and often requires multiple people within the business to answer some of the questions. But again, it is absolutely worthwhile to do this to make sure that not only is the underwriter fully aware of yourself as a business and what they should expect by taking you on, but for you to make sure that you're addressing all points that underwriters think are important in terms of risk management. The broker that you work with, like I said, should know about you and your business and the sector well enough to also have specific digital asset forms to pass on to you. And the questions you should be answering might not be absolutely specific to your business, but should be somewhat specific to the sector you're working within. If not, I would argue that you might be with the wrong broker. But it might be that your business, again, doesn't require specific digital asset insurance, and generic products might work for you. I would be wary, though, if you are only seeing very, very generic questions being put to you. Brokers work for you. Treat brokers like they're an internal resource. They're rooting for you. And once an insurer gets on board with signing for you, both your broker and insurer are absolutely some of your biggest cheerleaders and hope the best for you throughout the next 12 months. Trust insurance brokers to be on your side, working for your best interest at all times, whether it be getting insurance or claiming on insurance. And finally, for the rest of this talk, insurers are looking for businesses that have a great understanding of their own risk and have proven or shown that they've taken steps to understand it for themselves and mitigate it where they can. That will give insurers the confidence to understand that you are also thinking of their best interests, where you are not being sloppy with your business or using your insurance policy as the first line of defense as opposed to the last line of defense. And doing this and displaying that you understand these risks and you can articulate them and you have done things about them is what will bring down the premium on your insurance policy and what will get you the best terms, the broadest terms, and the most support from your insurer. If you do those things and work through the process to not only get them to understand who you are, but show that you understand very well who you are too, that's going to reach the best outcome you could possibly expect for when working with the insurance industry. I don't see any more questions, but I really thank you all for joining the conversation. I hope it's given you a bit of insight into the insurance industry. It's not as boring as it always is, as it always might seem. And there are some really interesting people there looking to help you and your business specifically trade well into the future and become a huge success.